So what is a buyer's market? Number one, the prices are lower and sentiment is negative. Now, under these conditions, buyers have an advantage over sellers. Now, the last buyer's market we had was in 2020. Okay, now it was during this time where if you had asked people around you what their opinions on the property market was, this is what they would have said. Now is not the right time to buy. We're going to wait to see what happens. Why would you buy now? Property will crash. Does that all sound familiar to you on what's happening today in 2023? Okay, you let me know. Now, at that time in 2020, in the exact same time frame, I was running webinars where I was literally begging people to buy property because based on the research that we were doing, the writing was on the wall. We were just about to go through one of the biggest booms in the market, right? And we were literally screaming off the top of our lungs that this was going to happen because we would have things like the strong government stimulus, huge tax cuts, our jobs budget, easier credit, low interest rates, strong underlying demand, and it was going to be a boom time scenario. Over the last couple of years, we've had literally almost 50% growth in the market across the whole nation. So if you were one of those guys that listened to the media back then and didn't take action, well, you've missed out on that growth, right? There's no other way to put it. But the fact that the market has come down over the past 12 months. Now, for most people, they get scared when they see something like that happen in the marketplace. But for me, I don't get scared. That gets me really excited. It gets my blood boiling with excitement because it is the next opportunity to get into the market. This is what we call a buyer's market. And it's always around buyer's markets where you get to make the most on your asset. Now, the reason why people get scared and they don't actually take action when they should be is because of the media. The media is a business, and this is the reason why negative future predictions are never usually right. The media is not there to help you buy property or to help you time the property market. The media is there to sell clicks. And just have a look at what over the past 15 years on what the media has been reporting about the property market, and it's a very clear pattern of negativity regardless of the market environment we're in. Take an example. In March 2010, Australia's property bubble, it's here, okay? 60% of investors believe that Australia has a property bubble. That's what they were reporting on. Now, if you had bought a property in 2010, you'd be laughing today, but a lot of people would have not bought property because of an article like this. Again, September 2011, deflating the speculation on the property bubble, home prices will halve over the next few years. It's a ridiculous statement when you think about it today, isn't it? And again, in 2023, Australia's housing market could crash. These predictions are all wrong. They will always be wrong. And the reason why they're wrong is because of this one chart. Now, if you ever want to know about property in Australia, all you need to know is this one single chart because this chart paints a perfect picture of what happened in Australia for the past 42 years. It's 42 years of data from 1980 to 2022, okay? And what this shows us is how the market cycles work. It's really important to understand property market cycles when it comes to understanding what's going on in the property market, okay? Let's just focus on the negative years. Now, there's a few insights I want to draw out of this, okay? Number one, 2022 represents the largest single year drop in the last 42 years. Now, I don't know what that means to you, but to me, that means it's also the largest opportunity in the last 42 years as well. A lot of people will see this and they'll get scared because a big drop like that looks scary. But the reality is that represents the largest opportunity we've had in the past 42 years. I wouldn't be taking that lightly. The second thing is there's never been ever 2 consecutive years of negative growth. You don't see 2 orange bars next to each other. It doesn't happen, right? And the third thing, right? The third thing is out of the past 42 years, how many of those years were in decline? So out of 42 years, there's only ever been 8 years where the market has actually gone backwards. What does that tell you? It tells you buyers markets don't come around very often. There's literally only been 8 in the past 42 years. So when they come around, you better make sure that you're ready and prepared for that to take on opportunities because it could be another decade before the next one comes around, right? Now let's focus on what happened after each negative year. Take a look at in 1982, right? In the following years after that, we have the growth rates of 10%, 7%, 15%, and 36%, right? Take a look at what happened after 1990. 3.3, 4, 5.8. Not as much as the previous cycle, but still, it's still decent. After 1995, look at this, 10.5, 11.7, 17, 14, and 15%. After 2004, 9.5%, 11.4%. After 2008, and 2008 was the global financial crisis, okay? What happened in 2009? Total rebound at 12%. Look at that. After 2011, we had growth rates of 10%, 8%, 10%, 5%, and 4%. After 2018, look what happened here. In 2021, we had a growth rate of 20% in just one single year. And then after 2022, what do you think is going to happen? Right? What's the likelihood that the market's going to continue dropping, right? 7% in 2023, another 10% in 2024, another 8% in 2025? Or do you think that in 2023, 2024, 2025, those bars are going to start turning blue in color? What's the likelihood based on history and the data that's presented to us, right? To me, it's highly likely that the market is going to rebound, right? And not just because of the market cycle, the property market cycle. Actually, the biggest reason why the market's going to rebound is because of mortgage rate cycles. Because mortgage rate cycles work on very similar, if not the exact same principles as property market cycles as well. Okay, let's take a look at what's happened since 1992 to 2022, so the past 20 years of mortgage rates. Okay, in the background, it's the same chart as before, but on top of that, you'll see the mortgage rates on the exact same time frame and how the mortgage rates have moved in that time frame. Specifically, I want to focus on all the years where the property market has gone backwards. Right, so in 1995, mortgage rates were sitting at 11.7%. 2004, 7%, 2008, 9.5%, 2011, 7%, 2018, 4%, 2022, 6%, right? So take a look at this. What you'll notice here is that every single time when the mortgage rates were at a peak and the property market went backwards, those were the buyer's markets. Those were the times to get into the market. Why? Because in the years leading up to those years, you can see that there's been massive mortgage rate increases. Mortgage rates were at a peak prior to the years that the property prices has gone backwards. It's very likely that when mortgage rates start rising, we are about to enter into a buyer's market. Now, on the other hand, what do you notice when the market grows is that the mortgage rates start declining. You can see big declines in the mortgage rates. And that correlates to all the bars going up, which means market is growing, okay? So we're at a peak of mortgage rates right now. The benefit right now is that we are at a peak in interest rates. What that means is that it's highly likely that the market, the mortgage rates in particular, is going to go backwards. And as a result, the property market is going to go up. Okay, now let's have a look at the price of an average property in each of those years. In 1995, an average property in Australia was $117,000. In 2004, $323,000. 2008, 412, 2011, 486, 2018, 661, and 2023, 849. So if all you did was just buy property in 1995 and you held that property, ignored what your friend told you, what the media told you, what the interest rates were, ignored all of that, and you held the property for 28 years, that property today would be worth $849,000. That's a 8 times return on your capital. 8 times return on your capital. Right? That's pretty ridiculous when you think about it. In 28 years, right?